And in financial news, Sunday marked the 5th anniversary of the collapse of the Lehman Brothers investment bank. In 2008, the firm filed for Chapter 11 bankruptcy protection following the massive exodus of its clients, drastic losses in its stocks, and a major downgrading of its assets by credit rating agencies. It marked the largest bankruptcy filing in U.S. history, and its demise became the catalyst of a major global financial meltdown in which the government shelled out $700 billion to bail out the big banks. At the same time, today marks 5 years since the Federal Reserve authorized a bailout loan of up to $85 billion to the insurance company AIG. President Obama observed the anniversary by speaking to the American people. While he sought to make the case that we're experiencing an economic turnaround, even he had to acknowledge that there's currently a huge economic inequality gap.
Because even though our businesses are creating new jobs and have broken record profits, the top 1% of Americans took home 20% of the nation's income last year, while the average worker isn't seeing a raise at all.
Well, here to talk about some of the lessons learned and why that gap persists is William Black, Associate Professor of Economics and Law at the University of Missouri, Kansas City. He's also the author of The Best Way to Rob a Bank is to Own One. And he's also a white-collar criminologist and former financial regulator. Bill, thanks for joining me. Now, you are a white-collar criminologist. What is the mindset on Wall Street that created this financial crisis in the first place?
Oh, making money. The key thing about accounting control fraud is, in the words of the Nobel Prize winner in economics, George Akerlof, it's a sure thing. You are mathematically guaranteed to report record profits. They're fictional, but you'll report record profits in the near term with modern executive compensation. The senior officers will instantly be made wealthy. The bank will suffer catastrophic losses, but the controlling officers will walk away wealthy, as they did at Lehman Brothers, where they walked away as, hundreds of millions or even billionaires.
And recently, a New York Times article laid out the inside talks of the Security Exchange Commission's deliberations on whether to charge the executive of Lehman Brothers. And after some back and forth, they concluded that suing the bank's executive would just be legally unjustified. Do you agree with that conclusion?
No, and I've done a couple of columns on this. The commission did not decide that. A particular enforcement lawyer decided that, and he didn't decide, according to the report, that there wasn't fraud. He decided a more technical thing, that it wasn't material, except that he's not the expert on that, and the experts in the agency disagreed with him, and the other folks were clearly right and he was wrong. So it's an outrageous abuse, and it is symptomatic of what's happened under the Bush and Obama administration, where we have the largest frauds in history, making the elites wealthier than ever in history, and not a single elite banker is even being tried, much less imprisoned, for the frauds that drove the crisis.
And of course, we know that no senior executives at any bank was ever charged. And this month, the month of September, marks the statute of limitations for any of the crimes these executives could have been charged with. So do you think that this will have a long-term effect on our economy or on the way Wall Street executives conduct business?
Yeah, one clarification. There's another law that allows, if the victim is an insured institution, like a bank or a savings and loan. So we actually could, for another 5 years, bring many of these cases because the banks did suffer losses. But there's no clear effort to bring those cases. And what it's all meant is we've just shown that you can get wealthy through fraud with absolute immunity. Well, think what that would do in the blue-collar sphere. If we said, hey, if you robbed homes, no one will prosecute you ever, and you can keep all the money. People would rob a lot of homes, and that would produce terrible things. Well, that's exactly what's going to cause in the white-collar sphere. It's going to cause bigger, nastier crises as soon as we actually get a strong recovery. But as your lead-in pointed out, we have not had a strong recovery at any time since the Lehman failure.
And Bill, you're a financial investigator, and you did work on the savings and loan crisis, which resulted in more than 1,000 prosecutions. How was the investigative response to the financial crisis in 2008 different?
Completely different. First, the key thing you have to recognize is that banks won't make a criminal referral against their own CEO. That can only come from the government. We recognized that back in the savings and loan crisis, and so our agency, the Office of Thrift Supervision, made over 30,000 criminal referrals. And as you said, this led not just to prosecutions, it led to over 1,000 felony convictions just in cases designated as major, and we hyper-prioritized the cases to go after the top 100 fraud schemes, the 600 worst individuals. We had a 90% conviction rate against them. In the current crisis, which is over 70 times larger, both in terms of losses and fraud, the same agency, the Office of Thrift Supervision, made 0 criminal referrals. The Office of the Comptroller of the Currency, which is supposed to regulate the largest national banks in America, made 0 criminal referrals. We believe that the Federal Reserve made 0 criminal referrals. The Federal Deposit Insurance Corporation was smart enough to refuse to answer journalists' questions as to how many referrals they made.
But Bill, I did want to jump in very quickly because we're running out of time, and I want to get one last question in there. You know, if you look at Wall Street now, it's clearly doing very well. And so if a healthy Wall Street is supposed to mean a healthy economy, why haven't we seen it translate yet into more jobs, more housing opportunities, and less foreclosures?
Because a healthy Wall Street doesn't mean a healthy economy. Wall Street is back to what it was at the peak of the bubble, about 40% of total corporate profits. It is an incredible parasite that reduces economic growth.
Well said. Bill Black, thank you so much for coming on, Associate Professor of Economics and Law at the University of Missouri, Kansas City. Thank you.
Thank you.